Welcome to Capital Link's company presentation series.
Nicholas Bornolis of Capital Link, and I would like to welcome you to Capital Link's corporate presentation series. We are delighted to have with us today the senior management of Dorian LPG, and they will talk about the company's development strategy and the outlook of the LPG sector. As a quick disclaimer, this is for informational purposes only. It does not include investment advice or advice of any kind. Also, logistically, we will start with a slide presentation by management, and this will be followed by a live Q&A session. Please, you can submit your questions through the Q&A button at the bottom of your screen, and your questions will be answered to at the end of the slide presentation. You can submit your questions anytime during this session. In closing, this presentation will be available as an archive for everyone to access upon demand after the live session. And with this, I will turn it over to Ted and John, and thank you for being with us.
Thank you, Nicholas.
Thank you, Nicholas.
Good morning. I'm Ted Young. I'm the CFO of Dorian LPG. This is John Lycouris, CEO of Dorian LPG USA and a member of the board of directors of Dorian LPG Limited. Let's turn over to our slide presentation, which hopefully everybody can see. One moment. Just a second. One more. You gotta be kidding me. It just worked. Oh, this is a disaster. Well, apologies, I don't quite have the technology right here, but hopefully everybody can follow along. Standard forward-looking statements disclaimer. So turning quickly to Dorian LPG, we are a New York Stock Exchange listed owner and operator of very large gas carriers. That's the largest segment in the LPG segment. That's liquefied petroleum gas, not LNG. And we'll get on to some of the distinctions between those two subsegments. We operate globally with headquarters in Stamford and teams in Copenhagen, Athens, and a joint venture presence in Singapore. We own 19 ships and have also have a couple chartered in ships, as well as this year we'll be taking during the course of 2023 delivery of 4 ships, 1 owned and 3 on time charter. As you can see, we've got a quite young fleet. We've made a significant investment in scrubbers, with over half our fleet being scrubber equipped. And that's paid big dividends, which we'll touch on a little bit later. And overall, we feel very well positioned and are pretty excited about what we see on the horizon. Turning very quickly just to the fundamentals of LPG. LPG is propane and butane. It is a byproduct of the production of oil and gas. It's split out after coming out of the wellhead. And some of it also comes out, about a third comes out of the refining process. And you know, the events in Russia and the decline in Ukraine and the decline in production out of Russia has actually had an impact on that segment of our business. Why LPG? It's cheap, it's easy to transport. A significant portion of LPG is used for heating and cooking, about 50%. So we have very stable base demand no matter what happens. The next biggest segment is the petchem segment. It's used as a feedstock for traditional steam crackers to make propylene. And it's also an important part of, or the only feedstock used by propane dehydrogenation plants, which is a direct on-purpose way of making propylene. And there's an interesting dynamic there that we'll touch on in just a couple slides about the trade-off between naphtha and LPG. It's also used to power a number of industrial applications. It's used as auto gas And it's also used around the world, particularly in the US, by farmers to dry their crops. To maybe give you some additional data, global demand for LPG is about 330 to 340 million metric tons. About a third of that is traded over the water. Most of that, or quite a significant portion of that, goes on VLGCs. The major production bases for LPG are, not surprisingly, the United States and the Middle East. Major end user markets are the Far East: China, India, Japan, Korea. It's different from LNG, and it's not interchangeable generally. LNG has a lower boiling point. It requires very different transportation needs. They've got a much more complicated containment system than we do. Ours is more art than science, I think. And, we have highly specialized crew that supports our operation. To give you some environmental statistics, LPG has about 66 kilograms of CO2 per million BTU. That compares with crude, which has about 77 kilograms, and LNG, which has about 59. And in terms of particulate matter, also extremely competitive. We've got about 0.02 grams of particulate matter per 2.5 million millijoules. LNG is lower at 0.04, but obviously very favorable compared to thermal coal, for example, at 2.7 grams. So it's environmentally friendly relative to the alternatives. It's abundant in supply. It's relatively cheap to transport compared to many of the alternatives, and it's relatively easy to do the last mile logistics, which sets us up well for growth in the emerging markets. Here's some of the world trade lanes. Again, as we talked about, North America through the Panama Canal to Asia is a major trade lane. Depending on the curve, you'll go around the Cape of Good Hope to Asia. There's also an increasing trade to Europe because LPG that might have been coming out of the refining process is not quite as present given what's been going on with the crude oil and LNG supply there. And of course, the Middle East continues to be a major supplier, and most of that product going to India and Asia. We gave you at the bottom just an overview of the three broad classes of vessels: pressurized, semi-ref, and fully ref. We're solely present in the fully ref and in the largest segment. VLGCs are generally vessels that have around 40 to 46,000 cubic meters of carrying capacity. That's somewhere between it's at least 75,000 metric tons and up. Largest vessels on the water today can do 91,000 metric tons. Most of our vessels transport about 84,000 metric tons. So turning briefly to what's been going on in the market, you can see that obviously, and this is presented as dollars per million BTU, so it gives you a real sense for how the energy price has changed. And that top green bar is the price of LNG in Japan and Korea. So you can see that that's obviously had hugely affected by the Russia-Ukraine war. Not as much of an impact through the rest of the other commodities, which of course sets up well for LPG. One of the things that's come out of this is obviously LNG is very dear, and one way that LPG has benefited from this is that LPG can be spiked into LNG to sort of expand its calorific value. Japan's been doing it for years, but other folks are picking up the slack and investing in or doing the same thing. So we've seen some marginal growth from demand there. Even in traditional steam cracking, which oftentimes uses LNG to create the steam, they've now decided that in this environment, particularly in Europe, that's no longer perhaps the most cost-effective way. So we've seen Evonik, which is a petrochemical producer in Germany, announce that it's moving all of its steam cracking away from LNG to LPG. And as you can imagine, in this interesting energy environment in which we find ourselves, product like LPG has benefited quite well. The EIA just came out with the updated forecast yesterday. next year, the next 2 years, we're expecting increases in production in the U.S. of 5 to 6%. The EIA is forecasting a 16% increase in exports for 2023 and 8% for 2024, which generally means that all the incremental export product and then some is going abroad. So that obviously sets up very well for our business. Just as a quick backdrop to that, U.S. demand is essentially flat, maybe slightly declining. LNG continues to take market share as a main source of heat here in the U.S., as I think many of our participants know. So what drives our trade? Well, there's two arbitrages that we look at. One is the East-West arb, which is quite simply the price of the product at the dock, plus a terminaling fee, plus freight, compared to the landed price in the Far East. And as you can see, the yellow bar on this chart represents the spot freight rate and what's sort of available in the market. And so you can see in over this time period, it's been quite healthy. We've had a very strong calendar 2022. We've been able to pay out a lot in dividends. And in spite of the decline that you can see in Mount Belvieu pricing, and even with its slight uptick, that freight rate has remained quite healthy for us. And so the market continues to be pretty good. Right now, day rates are probably around $65,000, $70,000 a day. That's down from $130,000 just a few weeks ago. As a reminder, we probably have. It probably costs us about $10,000, $11,000 a day in OpEx and G&A to run the ship. So you can do the math on EBITDA per day, and our cash cost per day overall, including debt service, interest and principal, probably runs about $23,000 a day. So in this environment, it's pretty healthy for us. The other main arb that we look at, and this drives that petchem demand that we talked about, which is about 28% of world demand, is the arbitrage between LPG and naphtha. And when LPG is cheap, and that's usually at least $50 a metric ton, we'll see petchem producers swapping out a portion of their feedstock mix. It's not 100%, it depends on the technology, but somewhere between 5 and 15% of the feedstock slate can be swapped out between LPG and naphtha. So as a result, when you see those negative bars on the right, we see that's good news for the LPG industry and for LPG shipping demand. And when we see those kind of rates or those kind of differentials, it's generally pretty healthy for LPG freight rates, like we're seeing today. And on the left side, even though we've seen significant growth in PDH, which is that on-purpose direct way of making propylene, there's still additional capacity coming online in traditional steam cracking in Asia, which will also drive continued LPG growth. So again, we see continued strong fundamental pull-through demand in our sector. To put the market in a bit of context, you can see that year to date, we've had high single-digit growth. The interesting aspect this year has been the strong growth of the Middle East. As you can see in the lower right-hand quadrant, their growth had been fairly stagnant for the last few years, but obviously as a consequence of Russia's invasion of Ukraine and the migration of those Russian barrels away from Russia and into other markets, the Arabian Gulf guys have ramped up production, and that's resulted in more associated gas, more LPG. So the OPEC cuts, didn't have a huge impact, and also from an LPG perspective, Russia had never been that major a player on the world export scene. They probably only exported 6 million metric tons of LPG, and about 3 of that went on rail cars to Central Europe and into the Asian republics, Kazakhstan, Turkmenistan, and Uzbekistan. And the remainder came out on mid-sized ships, MGCs, out of the Ust-Luga port up by St. Petersburg. So really not much of an impact from that perspective in the VLGC trade ever, but I'd say we have been somewhat beneficiaries, as one does not like to be in a tragedy, but it certainly has boosted LPG demand. You can see here that LPG global seaborne exports, the mix has grown, pretty steadily, and as the U.S. has taken market share from Asia, and we're now the biggest exporter. If you look back in time, immediately prior to our IPO in 2014, in 2013, the United States exported 4 million metric tons of LPG and imported about the same amount. We're now looking at exporting somewhere between 55 and 60 million metric tons. So very significant growth. And what we've tended to see historically with LPG is that when there is adequate supply, there is usually demand, and that's usually the swing takers. Of course, the petchem guys who are the most sensitive, price sensitive, but because of the abundance of the product, we've seen pretty steady growth in demand, and obviously the growth in propane dehydrogenation plants, not just in China, but around the world, which is, of course, supportive of LPG because there's no bit away from naphtha. Far East, of course, as we talked about, is the major driver. China is now the largest consumer of LPG in the world. In 2021, they consumed 71 million metric tons of LPG. I'd say about 25 to about 40% was imported. Some of it they're able to produce from their own refining activity. India has been a big growth market. It's used there predominantly for heating and cooking, about 80% of the demand. So from that perspective, it's very stable demand. Obviously benefited some from the COVID lockdowns as people were forced to be at home and eat at home. So that certainly was, again, a sort of a favorable aspect for LPG during the COVID lockdowns. We've already touched on PDH and the growth of those projects, but you can see there in numbers how significantly that's grown over time, and obviously been helpful to our industry. It's no secret for those of you who are followers, even casual followers of the VLGC segment, that we are looking at a somewhat large order book coming online here. The 45 ships is a big number. It's about as many as we had in 2016, but of course the fleet was less than half the size. So no one likes to have this many ships come into his market. But on the other hand, we already touched on the fact that we're forecasting pretty explosive export growth here in the U.S. this year. It's also worth noting that 66 ships are special survey due this year. Those ships will be, out of commission, not trading for 2 to 4 weeks, depending on what they're doing and where they're being dry docked. In addition, we have sort of the tail end of the fleet, which is aging out, and most of those older ships we admittedly don't see in our trades, but scrapping always helps. We hope to see some additional scrapping again in a higher interest rate environment. Anybody carrying debt with those older ships will find ships that have lower cubic carrying capacity, much higher fuel consumption, and potentially higher interest costs. So that could lead to some additional scrapping. But overall, we don't expect a cataclysm like we experienced in 2016 to 18, but there are a significant number of ships coming online this year and a few in the coming years. But also, as we've touched on, the long-term growth seems pretty good. So investors will have to make their own conclusions, but we feel importantly that as a company, we're well prepared to deal with whatever may come our way. We survived the downturn of 16 to 18 without going to shareholders for money, and we don't intend to ever do that if we can avoid it. Once the market turned, we had our balance sheet in shape, continued to make improvements in our balance sheet, and so through this upturn, as we said, we've returned a lot of capital to shareholders, about $500 million in total. Turning again a little bit back to more Dorian specific information, together with Phoenix Tankers, which is a subsidiary of MOL from Japan, we operate the Helios LPG pool, which is the largest VLGC pool in the world. The arrangement is fantastic because they're Japanese company. That's still an important market, and having relationships and insight into that market is useful for us. It gives us a virtual presence in Singapore, which is an extremely important LPG trading market, and they get the benefit of having our European presence and our European relationships. So we've been extremely happy with the relationship. We've had some different pool participants over time, and it's always something we're looking to grow, but we continue to be happy with how that positions us strategically. I touched on it a little bit before, but here in Stamford, where John and I are sitting, we've got 16 people, and that's finance, accounting, strategy, IT, all those good things. And our CEO, John Hadjipateras, sits here as well. In Copenhagen, we do our post-fixture chartering, our chartering and our post-fixture operations. We also have a fleet performance group, which is really important in this day and age, as one is looking to minimize emissions and maximize fuel efficiency and fleet performance. We have a couple guys dedicated there working on that, and they work very closely with our team in Athens, which does all of our technical management. That's where we really operate the ships from. So crewing, purchasing, technical management, marine operations, the real blood and guts of the day-to-day operation happen with our team of 55 folks in Athens, and really kind of great part of the Greek seafaring tradition that we have. But we operate everything as a wholly owned subsidiary, so no one has to worry about a misalignment of interest with third-party or related party managers on the outside. We feel great about our operation. It does allow us to engage in time charter business by having our own integrated operation, which we think is a significant selling point, because while the market is heavily time charter, spot charter based, we do think that the being able to compete for strong time charters with good counterparties is an important competitive calling card. John's going to talk about this, I expect, because we usually get a question about it in Q&A. How are we positioned for the coming regulatory challenges? As we touched on earlier, we've made a significant investment in scrubbers. That's been extraordinarily profitable, high return project for us. We budgeted, I think, a 3-year payback based on $150 a metric ton spread between very low sulfur fuel oil and high sulfur fuel oil. It's done better than that, and that even takes account of the time right after the regulations changed that required the use of VLSFO and coincided with the start of the COVID lockdown. So we had a period of time when there was not much of a premium, if any. So we're pretty happy with how that investment has worked out for us. As I touched on earlier, we're going to take delivery over the course of this calendar year of 4 ships that are LPG dual fuel. It'll be interesting to see how that works out. But again, it gives us that optionality and also very favorable emissions characteristics as well, which is increasingly important. And in terms of getting the architecture in place internally for all the tracking that's necessary to comply with the new regulations, our teams in Greece and Copenhagen have done a great job. We feel really well positioned, and it's going to be an increasing point of differentiation over time. So to touch again on what we think makes us unique, we've clearly got an outstanding fleet, lower than the average global fleet age, strong average efficiency ratio, which gives us a financial benefit of 5 basis points in our borrowing margin. So our lenders put their money where their ESG mandates are. Fleet continues to do well. They were contracted at the right point in the cycle. We've touched on our large commercial platform, which again is a great point of differentiation for us, and has continued to allow us to deliver outstanding chartering results. And finally, we have proven ourselves, we believe, to be disciplined and intelligent capital allocators. We have returned over $500 million of capital since our IPO. We've done open market repurchases. We did a $113 million self-tender offer beginning of 2020. And since that time, we've paid out dividends. They've all been irregular. We don't anticipate changing that, but I think we've paid out dividends the last 5 quarters 4 of $1 and 1 of $2.50. We've been able to do that because of the strong chartering markets, but also we made a number of changes to our balance sheet over time. And the capstone of that was the transaction listed there when we refinanced our remaining traditional debt facility into a 7-year facility. That's better than the standard 5-year that we usually see in the shipping industry, with we think a quite attractive margin over SOFR, 220 basis points. And at the same time, we were able to put a number of our vessels into Japanese financing structures that generally are longer dated, 10 to 13 years, and are mostly fixed interest rate at attractive rates, 4-ish%, and very favorable covenant packages. So we feel very well set up for the future, and we believe that we've got a proven track record of rewarding investors, and we intend to continue to act on that in the future. So with that, we're going to stop the formal presentations, and we will turn to Q&A. Yes, you'll have access to the presentation. So we have a question. We have a question on sort of overall regulatory outlook and how we see the challenges and the opportunities. John, do you want to talk about maybe what overall what we've been doing there? And I guess we have another question about will we consider putting scrubbers in the rest of the fleet? So maybe you want to take that.
Of course. Thank you, Ted. I'm more than happy to talk about the scrubbers. We were leaders in installing scrubbers on our ships. We installed 2 scrubbers when the ships were being built back in 2015. We wanted to learn that technology well. We thought that was a great opportunity for not only technological advance, but also for cleaner emissions. Way before it was even mandated or regulated to have low sulfur emissions, we thought this was a great opportunity to show to show ourselves how this technology can help. So we used those scrubbers since 2015, and we were more than convinced to install more scrubbers, which we did in 2019 and 2020. So we were preparing our fleet, and we installed 10 more scrubbers. So we have 12 scrubber ships right now. We are contemplating more scrubbers, and we think it's a great way to keep emissions for SOx, particulate matter, and carbon very low, because scrubbers keep all these bad substances out of the air. They are being diluted with water, and also we use caustic soda, which kind of neutralizes everything. So everything that comes out, whether it is up on the air or in the water, is neutral, is pH neutral. So we believe in that technology, and we feel that it has earned a lot of followers since we've done it. And the reason is that it is also proven to be advantageous in the bottom line, because heavy fuel oil is less expensive than low sulfur fuel oil. And there is a significant spread in the pricing. Currently, it stands about $200 per ton. So it's a significant kind of profit center for us. It has, as Ted said, paid off for the scrubber installations, and has made us consider the next steps of trying to make our ships more prepared for new emissions like carbon capture. The CO2 capture is the next thing that we are looking at, and of course, Scarborough will help in that because it combines all the streams of emission and exhaust into one funnel. We think also that the scrubbers do perform better than the ships that burn low sulfur fuel oil because they invariably produce less SOx and, as I said, also less carbon and particulate matter. So these are great instruments that have been installed, installations that have been done on our vessels, and we will consider more installations in the future.
Yeah, thank you, John. We have another question about current new build costs, timeframes, historical cost, how they compare to historical costs, and yards we prefer. Do you want taking that as well?
Well, of course, new build cost. I mean, it has gone up because there has been limited shipbuilding space. The yards went through a big spree of production back, as we said before, back in 2015, 16, etc. And since then, they had to reduce their capacity. As a result of that reduction of capacity, now they have found themselves with an explosion of container demand, LNG demand, LNG ship demand, container ship demand. LPG vessels have also, as you have seen, there's been a big order book of ships. They will take more than 2 years to be, to come out in the water, and the pricing has increased substantially in the last couple of years as a result of the limited capacity in the shipyards. And we have seen ships go up in price to build a new ship, whether it is a container ship, an LNG ship, or an LPG ship. They have gone up significantly, maybe by more than 10-15%. So we are we probably even some of them have gone up to 20%.
Yeah.
And
I mean, current new build price $9,500 million. Is that?
You would be lucky to get a ship at $95 million, and that would be for delivery 2026, most likely, maybe the end of 25, but I don't think so. And
that compares to our build cost of 72, 75.
That's correct. That is true. So there is limited space. Most of the shipyards now are building ships for end of 25, beginning of 26. So there is that situation with that.
Yeah, thanks, John. So we had a number of questions on the dividend, capital allocation, share buyback. So let me try to take all of those in one if I can. So look, we decided, I think, fundamentally that a dividend made sense because we did buy back a lot of our stock. I think when we went public, we had 56 million shares outstanding. And today we have 40 million shares outstanding. So we've repurchased a significant amount of the company. So that was at least part of the thinking and saying, hey, look, we've shrunk the float. And there is some virtue in that in a lot of ways because it can sort of spring-load a share price pop. On the other hand, we did feel that a dividend based on feedback from investors was something that would be attractive. We as share owners ourselves, obviously enjoy the dividends as well, and so obviously management's interest being aligned with shareholders is always a good thing. I think, how do we look at it? Look, we've intentionally, as we've said, kept it irregular, and we have intentionally not and will not be drawn on a formula. It's not formulaic, and we think being formulaic in a volatile industry like shipping can lead to some danger. So what we do with our board is carefully kind of look at the market environment, look at what we kind of see over the next few months, because really we have limited. We sort of have 3 to 4 months of visibility on our spot chartering, and so then we're able to do a pretty good cash flow analysis, and then we can make an assessment about. Again, with the board about how we feel about risks and opportunities going forward, and then come up with a level of dividend, if any, that we think makes sense. Part and parcel of that is there was a question about time charters, and our business has become increasingly a spot business. There are some time charters available; they're not frequent. I don't know that there's been enough inquiry recently that I'd hazard a guess on where the market is for a 3 or a 5 year time charter. 1 year time charters continue to be available. I mean, they're not that uncommon. We do them in our pool, but longer data continues to be a bit unusual. And so as a result, we need to be mindful of what the spot market looks like and what our cash needs are. We certainly want to maintain a healthy cash balance because we need to be ready for whatever the market may send our way. We haven't really reevaluated recently what criteria will be for share buybacks. Again, wouldn't want to be drawn on it because I wouldn't want to signal the market one way or the other anyway. But we've seen in the last year, our total shareholder return was fantastic. We were a top performer in a number of our investors' portfolios, which of course is heartening. And look, investors do screen on total shareholder return, and the beauty of a dividend is it goes dollar for dollar into your TSR calculation, whereas the payback on buybacks can sometimes take a little longer to see, and it may not be immediately obvious. So we don't exclude them by any stretch of the imagination. But again, given the favorable feedback that our investors have given us on dividends, we'll continue to probably keep that in the forefront, but by no means are we turning off the opportunity to repurchase stock at any point in the future. So that's, I guess, the best we can do on that. John, you want to talk about these port things? Do we see port facilities? Yes, may export. I don't think we're particularly worried about any export constraints in the U.S. I think we've historically seen, and we have some material in our broader investor deck, which is on our website, which shows the very steady growth in port capacity. There's a question here, sort of likening it to Ellen. Do you want to jump in?
Yeah, what had happened is, yes, Houston as such has had its share of weather accidents and things like that. The Houston Canal, Houston Channel does have a few problems, etc. But they have managed extremely well, and there are alternative terminals besides the Houston Channel. There is Beaumont that has a terminal there by Energy Transfer. Then there is Freeport, which is a little bit further down from Galveston, where there's a loading facility there. And also there is a loading terminal up in Philadelphia. So, and now we have significant export from Ferndale up on the West Coast, the north of the United States. So there is a number of export areas now that we have, and even if Houston gets some kind of a problem, it's usually being taken care of fairly quickly. and other places can arrange to, because the United States is well positioned with enough pipelines to be able to kind of move things around to various other areas where they can load ships, etc. The most important thing that has not been talked about here was that Panama Canal is a problem. Is many times we have big queues of vessels because all kinds of vessels go there. The priority is container ships, of course, as you realize, and also LNG ships. We, as far as LPG ships are concerned, we don't have such a high priority as those container ships, of course. But whether sometimes there is a lot of traffic going through the canal, and there is some waiting times that are causing a backup, and therefore a shortage of shipping, which increases freight rates even higher because there's just not enough ships available due to the Panama Canal kind of congestion. So this is something that we always watch. We always plan our passages, and we try to book as far as we are permitted to, because Panama Canal does not permit us to book that far in advance anyway. So this is something that one needs to think about as well.
Yeah.
So I don't know if there's any other questions.
I think
somebody asked about whether the shipyards, shipyard building VLGCs are a number of shipyards. There are a few shipyards that do that. The Koreans are mainly, and the Chinese. There's a particular yard in China that builds VLGC ships, and then there is a couple yards in Korea, and then there is Japan. So that's what it is. The quality of the yards of the ships built at those yards is pretty good. The Chinese yard has been building ships for 10, 15 years and has improved its product. There may be a small differential in the pricing of the ship, but it's really very small. And I don't know in the resale value if there's going to be a lot of difference, but usually they are considered a little bit lower technology, and therefore a little bit lower in resale value. Just maybe that.
Yeah. I think that generally covers it. We got a few questions about what's coming next on dividends. We understand the question; it's logical, but we're not going to be drawn on it. We'll announce quarterly earnings in a few weeks, and if there's an announcement, it usually coincides with quarterly earnings, and we'll sort of leave it at that. And we want to thank everyone for taking the time to listen to our presentation today. We're available for follow-up questions, and we also want to thank Capital Link for putting together such a great event. Thanks, everyone.
Well, thank you very much, John and Ted. I have to say I'm really thrilled, not just by the quality of your presentation, but by the avalanche of questions that we have been getting. I think this is one of the values of this type of session, the interactive, getting a lot of questions from the floor. So thank you to the participants, and of course, thank you to you for joining. And in closing, to remind everybody that this session will be available as an archive for on-demand replays after the live session. Thank you very much to everybody.
Thank you.
Thank you very much.
Bye-bye.